hit the subscribe button. Welcome back to the channel. Today we're talking about a financial independence guide to first-generation immigrants. Financial independence is predicated on the simple formula of money in versus money out. If you have more money in salary, passive income, gifts, or investments than money going out, which are your bills, you have discretionary income. With discretionary income, you may be able to save, invest, or spend. When you invest and save, you are moving forward journey to financial independence. Spending most of all of your discretionary income hinders your march toward financial independence. For first-generation immigrants, whatever you have in expenses in your home country or your new country, move forward on your financial independence journey by ensuring that your financials are secured. So let's talk about the challenges for first-generation immigrants. These challenges can be quite daunting. When a family immigrates to another country, they typically do not have the family or community support they had in their home country. This exposes first-generation immigrants to a number of financial challenges. These financial challenges include financially supporting family members both in the new country that they immigrated to and also in the home country. With regard to lack of community support, for most first-generation immigrants, with regard to childcare, there is no grandparents, sisters, or brothers to help. Natives also encounter this issue, however, to a lesser extent. Natives to a specific country have family in that country, whereas immigrants do not. On the financial front, for immigrants, there is no or very little inherited land, business, or assets in the new country. Immigrants, especially those who are the first to enter the new country, have to build wealth from scratch. Now let's attack remittance. A more challenging issue is remittance. Many first-generation immigrants have or feel obligated to send money back home to support family members. It could be to support studies or general home life. Remittance represent a large transfer of funds each year. For example, according to the World Bank, back in 2017, individuals sent over $689 billion to their home countries. And this is an issue mainly because in new country, a lot of family from back home will think that these new immigrants have money or are wealthy, which may potentially not be the case. To financially support multiple households, new country and home country, immigrants tend to be hyper-savers. As such, although in the aggregate, immigrants may have a lower amount of money in salary than most natives, many immigrants are hyper-savers and have higher saving rates than natives to a country. This does not mean that immigrants have more saved. As noted before, immigrant salaries tend to be lower than natives, and immigrants may have more financial responsibilities as compared to natives. This hyper-saving tendency may result, at least in part, on circumstances and necessity. However, because of financial constraints, in most cases, hyper-saving does not lead to financial independence for many immigrants. So what should many immigrants do? To move forward on the journey to financial independence, one must save and invest. While we are not advocating that immigrants should not send money home to their local family, cutting back on the amount sent must be considered. It is important to ensure that your financial situation is secure before aiding others, yes, including family. Think back to the safety procedures before a plane takes off. In an emergency, put on your oxygen mask first before your child's. The same applies to financial independence in your financial situation. Ensure that your financial situation is secure before trying to help others. If your financial situation is not secure at home, your family's in the home country and also in your new country, financial situation will also not be secure. Consider the following. You save very little while supporting your family in a home country and lose your job. In this situation, not only will you be in a bad situation, but so will your family in your home country. Scenario number 2. You cut back on the amount of support you provide to family in your home country and save a small sum in your emergency fund. If you lose your job, both you and your family in home country have a bit more runway to deal with issues that appear. This is the same principle that should be applied if you have adult children. First, address your financial situation, and where there is additional left over, aid your adult child. Again, financial independence is predicated on the simple formula of money in versus money out. If you have more money in than you have money going out, you have discretionary income. With discretionary income, you may save and invest, and that is the quickest way to gaining financial independence. For first-generation immigrants, take care of your financial situation before trying to aid others in your home country. If you like this video, subscribe to the channel.